Okay, so welcome again. In this case, we have the honor of having here Renée Friedman. We had it once, and this is the second time that we have her on the show. In this case, she's going to talk about risks and uncertainties for the global economy and for Spain. So Renée, thanks a lot. It's a pleasure to have you on.
Great, thank you very much for having me.
It's a pleasure. So go ahead.
Okay, great. There's a lot going on in the world. We're seeing a lot of things happening, both from geopolitical risks to the impact that's having on commodities and energy, etc., and global economic growth. So I shall steam ahead. So essentially, I'll take a look at what are the new and existing risks of what we're having: a global growth slowdown, reasons why inflation may stay higher for longer. I touched upon this a couple of months ago, and if anything, the situation's gotten a bit worse. The central bank reaction. Here I'll be particularly speaking about the ECB, but I will also mention what's been happening in the rest of the world, because obviously that affects global markets and sentiment, and the impact for Spain. And then I'll round in a bit on some of the specific situation for Spain in terms of trade, key sectors affected and why, and overall growth and inflation prospects. Essentially, we are looking at a global growth slowdown, and just came out a couple of days ago. This week, the IMF and the World Bank are having their annual spring meeting, and the IMF released its latest report where it now predicts global growth to slow down from 6.1% in 2021 to 3.6% in 2022 and 23. So basically, they've lowered this quite a bit: 0.8% for this year, 0.2% for next year, and in fact, it might potentially go lower. So what we're seeing as well in all of this is, of course, rising inflation, which, living in Spain, you'll know that inflation's been rising quite significantly, but this is a global phenomenon that's been happening. And we're seeing this with the slower growth in some advanced economies. It does pose a stagflation risk. Stagflation is when inflation is rising, growth is slowing or going into negative territory, which basically means people aren't, get into a mindset of they're not going to buy, you're not going to see capital investment, so it becomes a vicious circle. And it's very, very hard to get out of stagflation. Japan is an example of that for the past 20, 30 years. They've had very, very low growth rates and negative real interest rates for decades now. And we don't want to end up there. So the big issue is, of course, the question of the soft landing in the US, because the Fed there is looking to move in terms of its policies, and whether or not the US it's had very good growth, strong, tight labor markets, but whether or not it will be able to grow if the Fed raises its benchmark interest rates very quickly over the next few months. Inflation there is the highest it's been for over 40 years. And in fact, it's kind of all across Europe and the US, but it's the highest it's been in the US in decades. And the Fed is looking for an interest rate increases of at least 0.5% for its meeting in May, in June, and maybe even further on. And I actually suspect that it's going to go higher in the first meeting, throw the market off a little bit, because otherwise the fear is if they don't contain inflation quickly and come to terms with it, it will continue to persist and have that negative impact. But of course, is the impact that how that will hit growth as well. And unfortunately, the Fed does not have a very good history of engineering soft landings. They often tend to lead to recessions. Now that's for the US. The big issue, of course, is also for Europe, and it's containment in Europe. If we're looking at that slowing growth and that potential stagflation, because it will be, how does Europe get out of this if its global partner, the US, also is looking at potential recession down the line, which is the latter part of this year into next year. And of course, there are the major risks, and this is part of the containment in Europe, the worsening of events in Ukraine. We've seen this past week an escalation of events there. There's also the question of escalation of sanctions on Russia, And that in particular means we don't know whether or not there might at some point be sanctions on energy coming out of Russia. At the moment, there isn't. That could happen, and that will have a very strong knock-on effect, particularly in Europe, which is far more dependent on Russian energy than the US. Even though, for example, the biggest consumer, Germany, has said that it will stop its use of Russian energy by the end of this year, in the interim, it's going to hit markets globally. It will affect the gas price. It will affect the oil price quite significantly. So when I said inflation is up for this year, it's really it has potential to really go quite a bit higher. The other point is that we're looking at is potential deceleration in China, due to very strict zero COVID strategy. The ports in China have been closed, particularly in Shanghai, over the past month, I think. We've seen a backlog again in supplies. So we're looking at supply constraints globally again. Last year they're predicting a slowdown, or that starting to recede and supply come back. But with what's happening in China now, supply constraints are continuing. And there's also, of course, the fear of that, we may not be over coronavirus yet. We could get yet another strain. Although that doesn't necessarily appear the case. Well, nobody expected it 2 years ago to begin with. So although many of us are kind of now treating this we've had shots, we've been vaccinated, we've had booster shots, let's move on with things. We still have to proceed with a bit of caution on that. And the other big risks, of course, going globally is there's an increased probability of wider social tensions because of higher food and energy prices, which are weighing on the overall growth outlook that the IMF has put forward. So one of the things we're seeing with inflation is that, of course, we're seeing food price inflation grow up quite significantly. And this is due to the events in Ukraine, simply because Ukraine is a big wheat producer in Europe, big exporter. Also in terms of fertilizers, and a lot of fertilizers come out of Russia and Belarus, and both of those are sanctioned. So the cost of actual food production is going up quite considerably when you add in the cost of fertilizers and the access to fertilizers, as well as the actual energy that farmers need. So I'll get into, and that will hit Spain quite a bit. So I'll get into that in a moment, a bit further. So essentially, as I said, inflation is becoming far more entrenched. The IMF now predicts that inflation will be at 5.7% in advanced economies and 8.7% in emerging and developing markets, which is, as you can see there, it's up quite significantly from what they projected just this past January at 1.8 and 2.8 percentage points respectively. Again, energy prices increasing because of that increased demand. We did have low stocks coming in to this, various weather events. The obvious is geopolitical events, Russia, Ukraine, uncertainty around negotiations with Iran and its nuclear facilities. There is the conflict, again, people tend to forget, between Yemen and Saudi Arabia and other parts. We're seeing bombings in the UAE, et cetera, happening, and that hits potentially supply. Venezuela is dealing, questioning or trying to work with the US in terms of removing their sanctions on their oil production. And so that may or may not impact supply. There are the supply constraints that I mentioned coming from China, but there's also, of course, coming from the events in Ukraine. Shipping routes have been changed through Europe as a result. And also, it's not just in terms of shipping, it's also flights, because nobody's flying over Russia anymore. We're trying to avoid it. People still remember, or over Ukraine for that matter, people still remember a few years ago when I believe it was I want to say Indonesian airliner was shot down. So there's that issue. And of course, we're seeing the commodity price increases that I mentioned, not just in fertilizer, but also in metals. Copper, aluminium, et cetera, are going up quite considerably. And we have a lot of the rare earth metals are going up. And a lot of that, does have to do with green energy transition as well. And we are seeing overall broadening price pressures. For example, wages. Wages have gone up 5.1%, was most recent, I think, in the US. They are slowly going up in Europe, but it is not as much of a situation within Europe as it is within the US and other parts of the world. So this is just a very quick chart I pulled from Refinitiv that you can see for Brent oil, which is the global benchmark. We have seen this over the past few months, the oil price flipping back up and down, back and forth, but generally the momentum is upward. Gas prices the same. The one good thing about gas prices now over the past couple of weeks that we've seen is that as the weather gets a little better, as LNG supplies start to, have been filling in, as countries, such as Germany said, right, we're going to use our nuclear, although we're not going to close it down, which helps quite a bit in terms of energy. We may see some relief down the line in energy prices, but for now, they're going to remain very high. And again, if events in Ukraine get much worse or sanctions come in against Russian energy, expect to see some change here. So as I said, the increasing energy prices translates into increased input prices for goods and services that are to be produced or delivered. It's hitting household budgets, it's hitting consumer confidence, it's hitting business confidence, it's reducing consumer spending on discretionary outlays. So people are only, trying to budget very, very tightly and focus on what they really need now. Households are being hit quite hard. And as a result, that's slowing the economic recovery. And if we look at increasing wages, as now people's expectations about inflation are changing, and the ECB has insisted that they're not seeing this yet, but again, they're looking at back quite a bit old data. So, it might be happening. It depends when wage negotiations are taking place. It would mean increased prices at the factory gate and for services. So both sectors, and that both manufacturing industry as well as the service sector. And of course, for companies, that means lower margins unless their productivity also increases. And so the impact on growth overall. Well, the IMF has forecast for European growth is 2.8% in 2022 and 2.3% in 2023, which is essentially a downgrade. They've downgraded global growth, they've downgraded European growth. And for Spain in particular, I think when we were speaking a couple of months ago, we were saying it's forecast a 6% growth this year, at least, maybe more. Tourism's going to come back, everything's going to come back. It'll get better towards the end of the year. Well, forecast has been downgraded to 4.8% in 2022, 3.3% in 2023. The Bank of Spain was actually more pessimistic in their forecast. I think it came out a couple of weeks ago, so 4.5% for this year, which is almost a full percentage point less than previously estimated. And its growth forecast for 2023 is even lower than the IMF's, as you can see. So early in April, the Bank of Spain raised the average inflation forecast. It was to over 7%. Sorry, it's a bit of a typo there. I think it was to about 7.5%, which is more than what they had in December.
Yeah.
So that implied inflation of 9 to 10% for at least until July, when the bank expects it to moderate. But it was already 9.8% in March alone. So again, if we see events kicking off in terms of further sanctions against Russian energy, and there isn't agreement on other energy, particularly in Germany, which is a big user, and they start demanding, and they stick to their agreement about we're going to stop Russian energy, they're going to go for other sources of energy, and that's going to bid up the price on the international markets. So that figure of inflation may need to be revised upwards. Right. Now, I'm going to talk a little bit about the central banks. Now, I mentioned earlier the Fed is looking to raise interest rates. It wants to get to its neutral rate, which is probably around 3% now. It's a question of 2.5, 2.75. Now people are speaking about 3%. It's raising rates, it's taken, and we're hearing out of the Fed by various Fed policymakers, various Federal Reserve Bank presidents, people who are on the FOMC committee that makes the interest rate decisions, all being very, very hawkish and their tones out of the past, and this is coming over the past couple of weeks in particular, and it follows on from the last Fed meeting. The ECB is slightly different. In its last meeting, it agreed to discontinue its net asset purchases under the existing asset purchase program by the third quarter, which basically means it's going to stop pumping liquidity out. And they said, well, we could lift policy rates above zero, and they've not really been above zero, before the end of the year, unless the Eurozone suffers a severe shock. And it might even have to deploy restrictive policy to get surging prices under control. So essentially, we're starting to hear various ECB insiders saying, you know what, we're looking at it. I think maybe a rate rise might actually be necessary. And this is from an ECB who, up until a couple of months ago, was saying, well, it's transitory. Inflation is transitory. And now they're realizing the real impact of energy on the Eurozone quite significantly. And the events that we're seeing across, obviously from Ukraine, we've had a lot of refugee spillover as well. But it's really hitting the EU quite hard. So the market itself, when we look at what's happening in markets, even today, it is now pricing in a rate hike in July. So things are moving very, very quickly. July is still, I have to say, third quarter. So they said that they will consider it after they end their asset purchase program by the third quarter. So directly after that, they could immediately end the asset program and raise rates. At the end of the day, the main concern that people have is that if the ECB does not act, and there's a lot of reasons why it may not want to act as well, as quickly, particularly as the US, because the situation, to be fair, is very different. It could force the ECB to tighten credit far more abruptly later on, which would cause more pain potentially than if they acted sooner. And if they don't act, it may obviously negatively impact consumption because people are very worried about inflation, as well as investment, as both consumer and business sentiment falls. The reasons why the ECB may choose not to raise rates very quickly is simply because structurally, the labor market is actually quite strong in Europe. And I'll get to how well it's doing in Spain, although Spain does, which has been improving quite a bit actually over the past 6 months. But the situation is different there. It has to, I suppose, to a certain extent, the energy situation is very different. The US is a net exporter of energy, so it's not being hit as much. If you have a sudden appreciation of the euro, it obviously affect exports as well. So there are a number of things that the ECB is thinking about. They're looking at the data. They're very focused on the price stability issues for them, and the impact, a sudden rise in rates could have on economic growth as well. They don't want to end up in a stagflationary situation. I said the US is more likely towards recession. Europe and the UK are more likely towards stagflation. The other interesting thing that we've seen, and this is perhaps more to geopolitics, is the currency impact. The euro has fallen about 4% against the dollar over the past few months. And again, that is directly tied in with geopolitical events, geopolitical risk that's happened due to Ukraine. Right, getting into the Spanish economy. Well, we know that GDP growth is slowing in Spain. And in fact, growth was revised downwards for Q2. GDP growth in Spain is revised downwards. The numbers you can see there. The main reasons, of course, the Russian-Ukrainian crisis, the sanctions imposed on the Russian economy, and the increase in prices we're seeing, especially energy related over the past few months. And also what we're seeing in terms of the commodities, what we're seeing in terms of fertilizers, as I mentioned. So these types of things will hit Spain. Now, also, if we take a look at the unemployment rate, Spain is now at 12.6%. which is a little less than double, so almost double the EU average. And although youth unemployment is still holding below 30%, it has been declining. It is still amongst the EU's highest rate. The issues that we have are really for Spain: high energy cost, prolonged supply shortages, and a slow absorption of EU funds. And that's another big issue for Spain. Could really weigh on the economy. The government has approved, I believe, a 16 billion euro package in direct aid and loans to limit the impact of high energy prices on households and companies. But that will weigh on public finances down the line. Right. The specifics of Spain, of course, is that it is the 6th largest energy consumer in Europe. It has experienced hits to its key export sectors, and it potentially will experience key hits to its key export sectors. Tourism, even though that is in recovery. I mentioned Spanish unemployment. As I said, it continues to fall quite substantially, 12.6, because it was 14.2% in September last year, 13.1% in December. It's now this level. It's still almost doubled the rate of the Eurozone. The big issue for Spain when it comes to employment, and this is what I'll mention very quickly in a second in terms of EU budgeting, is that 1 in 4 Spanish workers are still on temporary contracts. So we're still looking at the changes in labor regulation in Spain and the implementation of the changes that are supposed to be happening in Spain. Now, when I talk about this point in terms of the hit to key sectors, and I mentioned agriculture in particular, Spain has successfully obtained a 64.5 million euros from the crisis fund activated by the European Commission to support farmers and stock breeders to cope with the increase in raw material prices and production costs due to the events in Ukraine. And the aid can be complemented with state aid. So they are looking to, hope that that the state will be able to step in, but the state is already having a bit of a, it's already extending its fiscal envelope, as it were. As I said, we have seen some signs of recovery in the tourism sector, including food service sector. The unemployment rate in the tourism sector during Q4, which was last quarter, 2021, stood at 10.1% compared to what it was even pre-COVID. So the situation is improving. But if we do see a slowdown in the EU, that may change the situation. Spain's exports have been increasing, which is a great thing. As you can see, exports have advanced by 3.7% month on month. This is based on February data. It rose 10.1% year on year. Its export-import coverage ratio has changed a little bit, though, because obviously the cost of its imports in terms of energy has gone up quite significantly. Spain's key trade areas are chemicals, so really it's been medicines and plastics. So the production of medicines during COVID has actually done quite well for Spain. Food, beverages, and tobacco, and in particular of that exports, which I think makes about, I want to say, I'm not quite certain of the percentage, of that, but the largest percentage is of fruit, vegetables, and legumes. And this is what will be affected by that increased cost of fertilizer. They'll hit that sector quite badly. Vehicles is another key trade area. And of course, with issues with automotives, is that they're not necessarily getting the chips that they need because of what's happening in China. So it's still the supply constraint problem hitting that sector. And down the line, we'll be looking at levels of demand as well. But for them, it's also a supply issue that will continue to hit the areas. And the same issue with capital goods, so machinery, equipment, tools, buildings, that type of thing. So for Spain, its key trading partner is the EU, which makes sense. It's part of the EU. It accounted for over 60% of its total exports in February 2022. The rest going to non-EU countries. So we know that if there's a slowdown in growth, it's going to hit Spain even more. Now, Spain does export approximately 10% of its exports to the Americas. And of that, it's about 9.8% last I saw. And of that, about 4.6%, but half and half, but 4.6%, maybe a bit more, 4.8, goes to the US, and the other half goes to Latin America. So Spain, could look to try to diversify its exports, or really do a push of export growth, or try to the US, which, as I said, its economy may also slow down at the moment. It's roaring ahead quite strongly. A very tight labor market there. Growth is good, inflation is very high, and as I said, the Fed is taking action. But as long as levels of demand stay strong, which wages are increasing there as well quite significantly, then the US should hopefully, even if it does start to slow down, it will not be quite the same situation as it is in Europe. So Spain could look potentially to try to increase its exports in that market, and also within Asia. So yeah, I will leave it at that. There's one last thing I wanted to mention, which I forgot to mention earlier, and that was on energy. What we know, obviously, is that this is something that all the negotiations are being very closely watched by the OPEC group and the OPEC plus group, of which Russia is a member. So even though we've seen the release of certain energy reserves, particularly from the members of the IEA, International Energy Association, and the US, it's brought the price of oil and gas down a bit, but not as much. And there's also the issue of the types of gas and oil that is used in both, from home heating to industry to what's used in automobiles. The grade differs, so you can, in terms of replacement, isn't always as easy. So yep, I think that is all I was going to run through. I think the one last thing, as I said, would be the situation changing if the Russian energy sector gets sanctioned. And the other thing pushing, of course, energy prices higher in the EU than anywhere else is the EU green energy requirements. Domestic gas production has been falling, or was falling, may have started to increase slightly, particularly in the UK. And of course, Asian demand. At the moment, that has slowed quite a bit because of lockdowns, as we've seen in Taiwan and in China. COVID has reemerged a bit through Asia, other countries in Asia. So demand on that has slowed, but when they get it under control, demand will kick back up. So I will leave that for now.
Excellent. So Renée, I have, listening to you, well, the first thing is that inflation is the catchy term. Now it's like, wow, this is hitting us, and it's going to be way tough. And what I see, there's a phrase that I've heard, I don't know when, but they said something like, inflation is one of the few things that are still made in America. Okay, so what do you think about this idea? Politicians, the Fed, for example, the ECB, they're pumping tons of money into the economy, and they've been doing that over the last decade, and it's something that it's incredible. And they, at a time, politicians, they happen to say that costs are increasing, the Putin is the culprit. So, but what about them? What about this enormous machinery pumping money into the economy? What do you think about that?
That's a very interesting question, and very good question, very pertinent question. Now, the ECB has, and I'll start with the Fed. The Fed has stopped its asset purchase program. It will be discussing and releasing actually in May how it will then get rid of what it actually holds. Some of which it may just let the bonds it holds. So some of which it may just let it keep retaining them and just let it run out. Some it may choose to release into the market. It's not clear yet exactly what they're going to do. And of course, it wasn't just the Fed acting over the past couple of years, past decade, but particularly the past couple of years. In the US, you've also had fiscal policy. People were getting checks directly from the government to be able to help them deal with the whole situation around COVID, and people being on furlough or only receiving a percentage of their pay, maybe not their full pay, or people being made redundant. So there was fiscal policy involved by the Fed. And that also obviously happened in Europe as well, where some governments did step in and, provide via furlough, paid companies to keep people on. It paid companies directly as well. So it's both fiscal and monetary policy having action here. With the ECB, it has been very slow. Again, part of the reason it had two different asset purchase programs. It's both its regular one and its emergency. It has stopped its emergency asset program, I believe at the end of March. And just looking at stopping its normal asset program that it's had for quite a number of years, as rightly pointed out, by the third quarter. And they've not been as specific about that. They're very data dependent. So when it comes to who's to blame for inflation, yes, this did feed into this. You had that level of quantitative easing, you had that liquidity being shot in to be supportive to the markets, but it also led to perhaps, there's always an argument when you have QE of asset price bubbles in certain areas, particularly in housing market. And when all of a sudden there's a shock to the system, and this has been we have the demand shock that happened due to COVID, and now, because of the events in Ukraine, a supply shock. So in these, and for a central bank, it can deal with demand shocks better than it can supply shocks, I think.
Totally.
Because it can try to shape behavior through the interest rates, whereas supply shocks is nothing it can do.
And touching on that, do you think that higher interest rate is the right solution in this case?
Again, it varies by country in terms of the levels of corporate debt and the willingness of capital investment will vary by country. Personal debt levels as well do come into it. So, it's going to hit, and always hits, of course, once you raise those rates, it hits the people who can least afford. Well, it's the issue with inflation, it hits the people who can afford it least, right? And all of a sudden, if they're paying a lot more for their mortgages, if they're paying, which would happen if there's a huge interest rate rise and they're on a variable rate mortgage, for example, it'll hit their discretionary income and how much consumers are going to spend. Quite a bit, which will have an implication for the economy. So it's a very tough balancing act, is all I can really say. I do think, having negative real interest rates, which is what it is now, is no longer a good idea. They have to bring the rates up. I'm not saying that they should go back to what Volcker did in the US in the 1980s, which was when interest rates were at 16%, or, all of a sudden, inflation was way up, and all of a sudden interest rates shot up quite dramatically. That had a really, it was really tough. And I don't think the global economy could handle that right now. And we're not even talking about, because when we also look at demands of global growth, we also tend to forget what's happening in emerging markets. Quite a number of emerging markets have been growing, particularly in Africa and in Latin America, for a number of years, but they're going to be really hit by this inflation, not just by inflation, but because quite a few are energy importers and quite a few are energy exporters and have been okay with that as a result. But, it's going to hit the level of demand for their products as well. So Yeah, a sharp rise in rates is going to hit funding for companies. It's going to hit households. So it's just the pace of which that rate rise happens. And getting it for the central banks, the real problem is how do they deal with changing expectations? Because this is a whole generation of consumers and people in business who don't really have any experience of inflation whatsoever.
It's a bit scary, actually. It's a bit scary. What I see is that it's a bit scary for people in general. I'm not sure if people is aware about what's going on. But yeah. So I have another question. That is, how do you explain that the ruble is now higher than before the invasion of Ukraine? That's another one, an interesting one, a challenging one.
Okay, interesting one on that. All right. The ruble basically lost half of its value when the events in Ukraine kicked off. Okay. And why it has gone up quite so dramatically? Well, part of it is the demand. This went into a few weeks ago when Putin was saying, we want payment in rubles. It was his way of getting hard currency into the country because it would require convergence, a transfer from whether it be euro into ruble, dollar into euro, and would therefore then bring hard currency into the country. It's a hard one to explain. Why this is happening. A lot of people have been writing about this. It is, benefiting still from the increase in the oil price itself, because it's still selling. People are still buying, even if they're selling at a discount to countries such as India. It's still being sold. It took a real beating. As I said, it's just not very clear why it's still that it's. I'd have to say the surge in oil and gas prices is the only reason I can really come up with, because it boosted Russia's energy revenue more than anything.
Makes sense.
Putin demanding that payments still continue in rubles. The funny thing is it's not. Well, I say funny, it's obviously not funny. Strange, to be a better word, but Russia tried to pay off its debt in rubles. So it is in technical default. It's sovereign debt. So there's a lot going on. So because the ruble has been appreciating, that's why we might see potentially, if the West really wants to go and punish Putin, we might see those sanctions. They're going to have to weigh up. If we sanction Russian gas and energy, okay, that'll hit Putin, but it's going to hit Europe worse potentially. So
yes, totally.
This is why the Europeans are kind of going back and forth about this. I think in terms of you have President Biden out of the US being very pro. We're going to get this evil man. We're going to do this, and Europe has to be a bit more cautious about these things.
Cautious, totally.
Yeah, so that's essentially what I would say. It doesn't mean that the sanctions aren't working, though. It is hitting, levels of growth within Russia, without a doubt. It just has to be adjusted. The question is how they seek to increase sanctions potentially. And it's not clear. And main thing is the ability of Russia to use its central bank to prop up its economy. And that's really the big thing. But yeah, for the moment, it's we're supporting.
It's a wise answer because it's complicated. It's very complicated, actually, very complicated. Okay, and the last question, Renee, is can you elaborate a little bit on your investment themes or risks or the way you used to kind of frame your investment ideas?
Well, we don't. Exante doesn't give any advice, so I just want to put that out there. I think
Okay.
this is a personal point of view of, where we're looking at things for people in terms of investment things. I mean, obviously the risks are geopolitical this year, and they're going to continue to be. It's both. But when we think about geopolitical risks, we tend to forget as well that there are still the climate change risks. So when people are looking at, and it's both a growth sector and a risk. So when I say growth sector, companies that are producing things to deal with climate change. As a risk, it's how it's affecting companies in their physical transition risk coming through. So ESG has not gone away at all, because we've all been so focused on inflation and what stocks are best, value versus growth. Tech, should I be in tech? Should I get out of tech? And I should say tech stocks have been very much affected by this. And they do tend to be when we're looking at an interest rate rise, because those are viewed as growth stocks. But when we don't know if we're going to have the investment necessary for growth, those stocks stop looking quite so attractive. And people go back to, and we see this in the market itself, people go back to the fundamentals. They go back to those non-discretionary items, to those non-discretionary sectors, whether it be pharma, whether it be what else would be a good example of a non-discretionary?
Cybersecurity, for example.
Sorry?
Cybersecurity, for example.
Cybersecurity is going to be an interesting
like
one as well. Again, that's a huge issue, because when we think about risks, we're so used to talking about, I said inflation risks or geopolitical risks, but one of the geopolitical risks is, and that's an excellent point, is actually cybersecurity risk. And this is one of the things when we see, cross-country hacking. This is a threat. People can get into systems, not just into governments. We always have, various TV shows of this teenager hacked into the Department of Defense type of thing and ended up, the feds are at the door type of thing. But it's actually more of it also in terms of companies themselves can be greatly affected. So cybersecurity is absolutely a huge risk. As well as companies that are involved in that protection is also an investment opportunity.
Totally.
So in terms of sectors, I would really try to take a look at what are the broadest sense of risks, from those geopolitical to those longer term ESG, climate. And when I say ESG, it's also the social and governance issues, because that still hasn't gone away, and that is changing, of course, in Europe under new EU legislation. Coming through on that. And again, as you've rightly pointed out, the cybersecurity risks. So when we think about our big risks as in terms of investment themes, it's not just about potential slowdown in China or what's happening in different parts of Latin America, or slowdown in growth in emerging markets hitting Africa or wherever else. I would put it in that broader canvas beyond just those short-term energy, because wherever there is a risk, there's also an opportunity within the market. That's why I said, if we're looking at energy risks, well, a lot of people it's various points, oil and gas stocks have surprisingly been going back up.
Yes.
Because of prices. But it doesn't take away from the fact that we have legislation that says, well, actually, you need to start reducing your investment as a company in this particular area and go more towards renewables, because we're going to require this. We're going to require your carbon reporting. We're going to be charging you a carbon price now. So people tend to forget that type of thing, that for the moment, I'll just be in this. It really depends for most investors of what their time horizon is for their portfolio. So there are a lot of short-term things they need to consider that will be hitting both their stocks and their bonds that they may be holding, and then taking a look at what they want to hold for the longer term as well within their portfolio. For the medium term, long term, of course, everybody's dead, but for the medium to longer term for them. So I would say in general to take really take a thing of when we think about geopolitical risks, look at it by country. Some parts of the world, as I said, we have a higher risk of food wars as well as water wars, which people tend to forget about that. When I mentioned earlier in the conversation, one of the things that the IMF does mention is, well, we could look at more cases of civil unrest if there are a massive increase in food prices. Well, parts of the world, for example, Egypt, has had food riots in the past, and that affects the Suez Canal, which will affect shipping. And we already saw from last year where one little tugboat got caught in the canal, the impact that had on global shipping.
Totally.
Domino effect. So,
exactly.
You kind of have to take a look at these things at a country by country, if you're focusing on that within your portfolio as well. So it's both sectoral and by country, I would say. It's kind of a hard thing to do, but it's probably your best way to try to balance your overall risk of your portfolio.
Thanks a lot, Renée. It's been a pleasure to have you again. I hope you want to come back next quarter and enlighten us about what's going on in the world, because it's a pleasure to hear you. So thanks a lot, Renée.
Thank you so much. Thank you.
Thanks
and I'm sure it'll be a wild ride coming through the rest of Q2 into Q3. Because I
can't wait.
Yes.
Can't wait. This is gonna be really. I think it's gonna be really tough. So yeah, it's very interesting to have you and help us understand,
etc. So yeah, it's going to be some big things happening. But thank you very much.
Excellent. So thanks to you, Renée. Okay, so we'll be in touch. Bye bye.
Okay, great. Bye bye.